markets. It has been a bumpy ride for investors so far this year. My next guest says embrace the uncertainty and the opportunities it provides. Want to bring in Eaton Vance, Chief Equity Investment Officer, Eddie Perkin, joining us this morning. Eddie, good to see you.
Good to see you.
How would you characterize markets today?
Today, I think we're going to see a down open, but
well, not necessarily today.
Yeah,
I mean,
but in general, I think the U.S. economy, I think, is stronger than people give it credit for. We're seeing better data out of the transports. We're seeing transportation stocks act better. We've had our analysts speaking with consumer company CEOs recently. They're more positive. They're the most positive they've been in 5 years, and sentiment, in my mind, is uniformly negative. And so I think it's still a good time to maintain exposure to equities.
So no recession this year?
We were in the fall saying that we thought there was a reasonable chance, maybe even as much as a 1 in 3 chance of a 2016 recession. At that time, nobody was thinking that way. Now it seems like that's become everybody's base case, and yet some of the data that we just talked about, particularly the rail data, is getting better. And if you acknowledge that, then I think there's a good chance there is no recession, and I think in most scenarios, stocks will perform well.
So you got $300 billion in assets under management. You're largely invested in stocks.
We are. I oversee the equity group, which is about $35 billion of that $300 billion, and we're fully invested, running very low cash levels and beginning to favor value stocks over growth stocks. We think there's more opportunity in that part of the market.
Eddie, I completely agree with your outlook on no recession this year, but I think we have to acknowledge that the oil prices and the selling from the sovereign wealth funds from the petrostates has so dominated the market narrative so far this year. Do you really think that's over? And do you think that stocks have put in a base, or do you think that we're going to still be at a slave to the whims of the oil market?
Yeah, I think it's a good point. I think there are a lot of selling pressures both from sovereign wealth funds and from some of the large hedge funds that have been de-risking as well. So there are technical factors that work in the market that mean over the next several days or weeks, it's anybody's guess which direction stocks go in. But I think over the course of the full year and beyond, stocks are now priced, certain parts of the market at least, are priced at a level that give long-term investors an attractive entry point.
One problem is a story out on today that hedge funds are more bullish on the 10-year Treasury after a 2-month gain, and I think the most bullish based on futures in like almost 3 years. And that's an indication that the Treasuries are probably overpriced and ripe for a sell-off.
Yeah, I think hedge funds, in my mind, often behave like retail investors. They tend to pile into the same types of stocks, same types of positions.
Yeah, you're right. That's fine.
And I don't know if I would characterize it as bullishness as much as fear. Fear and hiding in those safe securities like gold, like treasuries. And to me, there are stocks that have very safe, attractive, growing dividend yields that are 100 basis points north of where the 10-year Treasury is trading. So why would you go there when there's better opportunity in the equity market?
Yeah, top story in the Journal, dividend-paying stocks outperforming the broader market so far this year because investors are not expecting more rate hikes.
That's right.
Yeah.
That's right.
Go ahead, Dave.
This is great at this level, at the macro level. We're looking at companies, investors, large investors. But a lot of people watching want to know, what does this mean to me? They've lost so much, whether it's portfolios, where their portfolios, their pensions are invested, their 401ks. And the guy on Main Street doesn't realize it oftentimes how much the market matters to them. So what does this matter to the guy on Main Street?
Yeah, I mean, I think if you're a long-term investor, if you're an ordinary person who's investing in markets for retirement, to save for college, and you have a very long time horizon, you've got to try and turn off the daily noise and focus more on the long term and the valuations that are there for the long term. And so, try not to look at your 401k statement too often.
So you don't want to time the market. Where are you seeing value right now, Eddie?
We're seeing value in some of the more cyclical parts of the market, so industrial stocks, some of the bank stocks, not all of them, but some of the bank stocks, and some of the consumer discretionary stocks, particularly retail, that is really beaten up right now.
You like financials?
We've lightened up a bit on financials. They're obviously going to have a little bit, it seems like, a headwind from some of their energy exposure. It's not a risk to the system. It's just a headwind to earnings. What I'd love to ask you...
Also low rates for longer, big time.
And a flattening yield curve. Let me ask you, Eddie, because you're talking about you're fully invested right now, and Dagan was talking about treasuries being so low. but corporate bond spreads are not low. They're very high, and yields on corporate bonds, both investment grade and high yield, are extremely attractive. They're really pricing in recession. Do you think credit spreads are going to have to tighten before the market can rally again?
Yeah, well, I think we've seen a little bit of tightening in the last 2 weeks, and that's been coincident with the equity market rallying. I think if you buy bank stocks, that's sort of the proxy in the equity market for playing credit spreads. I agree that high yield is a cheap asset class. I think bank loans are a cheap asset class, and the way to play that in the equity market is to favor the banks.
Yeah, see, I think I'm beginning to agree in terms of this economy showing some signs of vibrancy finally. I think we are beginning to see something where we could be poised to turn, only because balance sheets are where they are. When you look at where the savings rate is and the corporate balance sheets with all the cash, once that sentiment turns even a little, it's going to be strong.
I agree with that. I mean, the animal spirits have been missing for several years. I think a little bit of improvement in capital spending would go a long way, and we've seen such a pullback, particularly in the energy sector, on capital spending, that simply lapping the year-over-year change, we'll start to see some positive numbers on that front.
Unless there's a surprise out there looming that will surprise us.
Which nobody can ever get. That's what it is.
It's much more negative. We'll see. But Eddie, good to talk to you.
Thanks.
Thanks so much for coming in this morning. Eddie Perkin joining us there from Eaton Vance.